Then I say that in early 2025, a unique buy the dip opportunity will arise, perhaps the last chance to buy a few incredibly strong companies for the long term. In this video, I've selected a number of stocks for you that have become potential value stocks. This is about competitively strong companies that have declined significantly for certain reasons. And because we research a lot of stocks daily, we've noticed that there has recently been a significant decline in the consumer goods sector. Stocks like Heineken and AB InBev have also dropped significantly, even by up to 70% compared to their previous prices, while the company itself hasn't even become worse or has even improved. So these are interesting opportunities for further research. Not only that, we're going to talk about 7, let's say, strong companies that have dropped to zero in market value. So fallen stocks with a buy the dip opportunity, possibly also undervalued. In addition, we will discuss 2 additional ideas in the consumer sector, but this time based on growth. So these are actually growth companies. It may be that these traditional companies that are now declining, that it is actually more the story of yes, with time everything lies ahead, and that those other 2 might actually be growth stocks that will replace the rest, but they are just specific other products, so I don't think that is the case. And why 9 stocks that might be interesting for you with 7 potentially undervalued stocks and 2 possible growth stocks? I'm curious to hear what you think, and keep in mind, this is for inspiration for further research. Very briefly, my name is Yorick Vermeulen, owner and founder of Happy Investors. In the meantime, we have a larger team. I myself am the investor, and I've been investing for 10 years now. Also make analyses of investments, stocks, and ETFs. And I hope that with these videos on YouTube, I can help you find some inspiration for financial freedom. These stock analyses are, of course, for inspiration, at your own risk, and above all, invest in what you know. So only invest in companies where you can estimate, hey, this is the intrinsic value, and I can buy below the intrinsic value with a margin of safety, because that's how you can actually achieve an extremely high return with minimal risk. And in this selection of stocks, I think there is one that may meet the criteria, maybe even more, but I know for sure that one qualifies. If you appreciate this video, please give it a like and subscribe to our channel. Why? That helps us grow the channel. The more our channel earns, the more free content I will create for you to help you with financial growth. Hopefully with good tips, but there will also be bad tips. That's the reality. This is not a filtering of the very best selections. This is purely preliminary research, so keep that in mind. I can only be honest because I prefer to be honest and set the right expectations rather than create nice stories and ultimately leave you with bad stocks. So that's not the goal. The goal is to help you, in this case through YouTube, with inspiration, free stocks, tips for further research, and those that may have a good chance of success. The first buy the dip stock in the consumer goods sector is Heineken, which we will discuss in this video for inspiration. We see that Heineken has dropped significantly, even by about 37% to 38% compared to a year earlier, and for example, compared to 2022, it's down 22%. Now, Heineken is even lower than the price level during the Corona crisis, and currently the price has dropped to the level of 2015. So what's going on here? That's of course the crucial question. Actually, it just seems to be looking at harder facts and statistics. Then it seems that Heineken is potentially undervalued. We don't know the exact entry point because the price is still negative and declining. So it might be better to wait until there's some sort of bottom. But the current price to earnings ratio seems very high at 35, but it has recently dropped. A price to earnings ratio of 15 for Heineken is not on the high side, and the earnings growth estimates we see below are very solid according to analysts. The question, of course, is whether they are right or not, and if they are right, it seems that Heineken could achieve long-term growth. That's why it's an interesting value stock. With a potential return of about 16% including dividends, however, if we apply a higher multiple, and that of Heineken is usually around 15, we could even achieve a return above 20%. PepsiCo, which is generally considered a strong company with a solid moat, has recently dropped a lot. Everyone is opting for tech stocks, while these great companies are really struggling, even with a 60% drop compared to the last peak. In 2023, or since the peak or the decline of 2022, it's now down 10%. And as you can see, the price has dropped to the level just before the Corona crisis. The price could still drop further, you never know, maybe it will even fall to the levels of the Corona crisis, but that would mean an additional drop of about 10%. It's realistic, it's possible, especially because the trend is negative, but if we simply look at the valuation, then the stock seems to be undervalued at this moment. The current price has recently dropped so much that it's almost actually touching the fair value line of a price to earnings ratio equal to 15, but the blue line represents the normal multiple, and in this case, I would use the normal multiple for PepsiCo. Why? Because it's just a great company, and of course, you pay a slightly higher price for that. Well, here is the normal multiple of 25 over a time frame of 7 years. However, I indicated here that let's take the lowest multiple as the average, and that is 20.7. Sounds realistic for this type of large companies with a sustainable competitive advantage. The profit growth isn't that significant anymore, as you can see below, but it all seems realistic if a company can still achieve 5% profit growth. The current price to earnings in the future have dropped, which means a potential return of about 15% on average. It does seem more attractive than possibly the S&P 500. Moreover, there's also some dividend and maybe a lower risk profile considering PepsiCo's market position. If you're considering investing in PepsiCo, you definitely want to compare it with similar companies like Coca-Cola, of course, the biggest competitor. Now, Coca-Cola is a bit less interesting. The recent drop is quite significant at 15%, but it could very well be that the price drops further by about 13%. Then we actually get a total drop of about 25%. It has happened more often, and here it seems like there is a technical support level at a technical level. But what's much more important, of course, is for long-term investors to look at the valuation. If we look at the historical scale, we see that the current price has dropped to the normal multiple. If we really look at a more recent timeline, then the price is below that. That's only because the normal multiple here has increased to 24. I don't think that's a good measure. Let's use the same multiple as PepsiCo, which we said is 20. Pfizer's earnings of 20 for Coca-Cola seem relatively better. Yes, the growth potential is of course a bit less, but as long as the company continues to grow, Coca-Cola will also be able to grow, and they can always make more profit due to efficiency. So let's assume for convenience that the price to earnings of 20 is still realistic, for at least the end of 2027, and beyond that no one knows. Well, if everything moves in perfect condition and the analysts' estimates for OPS growth are correct, then PepsiCo at this level, Coca-Cola at this level with Pfizer earnings of 20 could achieve a return of about 6.5% per year, including dividends. So PepsiCo could achieve 15% per year, which gives PepsiCo a more interesting risk-return profile. This is also true for Coca-Cola FEMSA, a company that actually bottles for Coca-Cola, which has recently dropped a lot again. The recent price drop is about 23%, making the valuation interesting again. I bought Coca-Cola a while ago. Coca-Cola FEMSA, my apologies. At this moment here, around October 31st, and I sold on March 23rd, which is about here, with a return of around 20%. We can see in my portfolio update here, we see Coca-Cola FEMSA, sold on October 31st, 2023, and sold in March 2024, my apologies. And March 2024, apologies. And in retrospect, it may seem like a good move, because the drop from that level has been minus 20%. Moreover, every month I provide updates on my investment portfolio, so definitely follow and subscribe to us, and also give a like to this video. That helps our channel grow, and I would really appreciate it for all the input we provide you for free to help you grow financially. A small favor you could do to help us is to subscribe and like the video, thank you. Now, there may be a potentially interesting new entry point for Coca-Cola FEMSA. I'm not buying at the moment. I took a profit of about 20%. Actually, I wanted to buy it for the longer term, but I sold because I saw a better opportunity. That was the reason for me to sell Coca-Cola FEMSA. If you look at the valuation, right now Fast Grabs isn't doing well, so we can skip that one. But the price to earnings ratio is now around 14.5. And for next year, since there seems to be interesting growth for this company, it comes out to about 13.3. But other ratios aren't overly expensive either, like the price to sales ratio, which is approaching almost 1. The book value ratio is indeed on the higher side. And look, they also pay a relatively high dividend of about 5%. So besides the potential capital gains you can achieve, you also have an annual dividend of 5%. So that should average out to around 10 to 15% per year, provided Coca-Cola FEMSA achieves an EPS growth of more than 5% in the coming years. We started the video analysis for a potential dip opportunity in Heineken, a value stock, and a similar value stock is AB InBev. Also, AB InBev, primarily known from Belgium, is a large international beverage company in the consumer goods sector. AB InBev has recently dropped by about 20%, but as you can see, if we zoom out and look at the peak from 2016, it has fallen by about 60%, a huge drop in stock price. I think more research needs to be done here, and that applies to all companies. But what's fundamentally going on here that AB InBev keeps declining for so long? However, it seems that purely based on forecasts, which of course aren't always accurate, AB InBev could achieve an interesting return from this level. If the price continues to drop, that would be nice in principle, down to the level of the Corona crisis, which would bring you to a price level of 40. That would mean a further decline of 15%, which is already quite significant. Then it would reach the same support level as in 2011 and at the Corona level, but now the level of 2010 has also been reached. I can't imagine that AB InBev is a worse company today than it was in 2010. The price doesn't say much, it's about the company's growth. The stock price is below fair value. And has the competitive advantage, the moat, become stronger, yes or no? If we look at it purely from an objective historical valuation perspective, then for the first time in a long time, the stock price has dipped below the fair value line again. And as you can see, that has happened a few times before. 2020 during the Corona crisis. It happened in 2011, what we just talked about, and it actually happened after the financial crisis. Then it really went under the radar. But in all three of these situations, the stock price rose significantly afterwards. So that's also the case for ABI at the moment. If we zoom in on a slightly shorter time frame, it also seems that the stock price is coming in below fair value. So it could be that ABI is simply undervalued based on its intrinsic value, where we use a price to earnings multiple of 15. That price to earnings ratio has fallen below 14. A price to earnings ratio of 15 with the mentioned growth figures below could mean that the return is around 18% annually, and that's obviously not perfect. You know that too. This will come with ups and downs. It seems that it offers more potential than riskier stocks in, for example, technology, which are currently highly overvalued. For Heineken, we used a price to earnings ratio of 18, so if we do the same for ABI, which is of course different for a company than Heineken, but then the average return would even be higher, 25% per year. So it's definitely worth taking a closer look at this potentially undervalued stock with a margin of safety as a buy the dip. As a value stock, Heineken has dropped a lot, AB InBev has dropped a lot, and now we have Ambev. Ambev might actually be in the same quadrant as the previous examples. Why? Because this company is positioned in Brazil, and Brazil is currently suffering from macroeconomic challenges like very high interest rates and inflation, so that weighs heavily on the stock price of this company. AB InBev has really dropped a lot. Compared to, for example, a random position in 2022, the stock has dropped by 42%. The current stock price is below the pre-COVID level. By the way, compared to the pre-COVID level, and up to today, the stock has dropped by 61%. Can it get any worse? Yes, it can get worse. AB InBev was apparently at its highest valuation in 2013. Since then, the stock has just dropped by about 80%. The woman is violating. What's going on here? This company, which has grown over the years, is almost at the same stock price level as in 2004, and actually still a bit above the price level of the financial crisis. But 2004, we're now 20 years later, the company has grown a lot. What's going on here? Probably just market sentiment. I think that's Mr. Markets. It just seems, based purely on the statistics, that not much is going on. So yes, here's someone who understands AB InBev and also the market they operate in, and of course management is important too, and can assess whether the company will make profits, more profits in the long term. Then this seems like a great value stock. And exact price drops can continue, but I have no idea when the bottom will be. And of course, I'm really curious about what your insights are regarding AB InBev. Please let me know if you know more about this company. Looking at the historical valuation, the current stock price has dropped for the first time below the fair value line. That has only happened a few times before, a few times recently, but the last time was during the coronavirus crisis and also the financial crisis. Also, if we zoom in a bit more, it seems that the price is at least below the intrinsic value, so that means it's undervalued. The price to earnings ratio right now is 11.5. The company is indeed affected by those economic developments, but the question is there profit growth to be achieved? Analysts think so, although it may not be that many, 15, 9, and then 1. And for AB InBev, yeah, it's hard to say what the standard multiple is for this type of company. You always see that it's actually above 15. Let's assume 15 as the normal price to earnings ratio, because the price has dropped so much and profit growth is expected to be relatively high. You always see that it's actually above 15. Let's assume 15 as the normal price to earnings ratio because the price has dropped so much and profit growth is expected to be relatively high. And I think it's fairly easy for the companies to achieve these numbers. 12% profit growth is a lot, but when you've dropped so much, it's easier to achieve faster profit growth. So the return could be significantly high. Is something going on? I can't find many remarkable things that quickly, except for a bad luck ratio that, according to the data model, is super high because the price to earnings ratio is just relatively low. The price to cash flow is 6 at the moment. The dividend yield is almost 6%. Let's take a look at the profitability. For example, the profit margin is 17%, but the 5-year average profit margin is 18%. So that's somewhat in line with just the 5-year average. So it doesn't seem like there's much going on. Also, the return on equity, return on total capital, and of course, return on assets are all quite good, and also in line with the 5-year average. For example, let's take a look at the cash flow statement. Then we obviously want to look at, okay, what is the operational cash flow? Well, that's 4.7 billion. We have a market capitalization of 30 billion. And this is the ticker, the international ticker we use for ABEV. The market capitalization is 30 billion. Well, they don't have a lot of it. I looked at the balance sheet and I don't see many remarkable things. The cash position seems fine, so there appears to be liquidity and solvency in the short term. So a market capitalization of 30 billion, and we have a free cash flow of 3.7 billion because we have 1 billion in capital expenditure. We subtract this from our operational cash flow, leaving you with 3.7 billion, or 3.8 billion. You divide that 3.8 billion by the market capitalization, and you get a price of 8 times free cash flow. A price of 8 times free cash flow isn't super cheap, perhaps, but for such a large company like Ambev, yeah, it can always be cheaper, but this does seem to be a good deal. I wonder if you had the chance to, and you had 30 billion, and you could buy this company with your 30 billion. For a free cash flow of 8 times, would you do that? Yes, there is of course competition, and I have no idea what the long-term potential of ABA is, to be honest. It just seems like it's better buy low than when it's really high. And the only thing is that in the short term, the momentum is just very negative. So that negative momentum could last for a longer time until it's clear that positive momentum is coming back from positive news. And of course, developments can happen right away. And what is it about? At least not good. Do you know more about Abev? Let me know, thank you. Then we have Diageo. I'm not sure how you pronounce it, so that's not really very positive. But Diageo, I assume you pronounce it like that with the ticker DGE, is also a last value stock that has really dropped a lot. If we look at the short term, we see that MACD is starting to take on a positive line. That means that at least in the short term, the momentum is increasing a bit. The overall trend is still negative. It would be interesting to see if the price that's currently falling finds a support level around this price point of 2300 to see if a bottom is forming now. But the overall valuation is less interesting in relation to future growth compared to, for example, the other companies we've seen, Heineken and AB InBev, and also Ambev. The price has decreased significantly so much. This stock is down approximately 40% and is almost touching the price level of 2017. Why is it a bit less interesting? Despite the significant drop in price, the price to earnings ratio is still a bit on the high side at 17. So you're looking at the historical valuation, and it's not below the fair value line, even when we zoom in on, for example, a 7-year time frame, and we can also see that reflected in the forecasting. The normal multiple over the past years is around 20. For example, we had a price to earnings ratio of 18 for Heineken and AB InBev. We saw that they could potentially achieve returns of 15 to 25%, and for Diageo that could be 12% based on the current estimates. And those estimates from analysts are constantly changing, so this could either fall short or exceed expectations. However, when we use a lower multiple, the potential return isn't very high, so for me, this wouldn't be a reason to invest. However, you really need to do a lot more research on the position of this company But it's such a large company that often, because it's covered by so many analysts, these price estimates tend to be fairly close. What could happen then? Well, for example, a black swan event or macroeconomic developments, whether positive or negative, those kinds of things can always throw a wrench in the works or lead to positive surprises. Of the stocks we've mentioned in this video, this one would be my last preference. I would rather look at, for example, AB InBev or other stocks like PepsiCo. The companies we've discussed are all established companies with a strong competitive advantage and not much future profit potential. So that might be the narrative, the story behind the decline of these companies, and why, of course, as an investor, you want to invest in the next big thing, the next growth company that's going to take over the world. One of those companies might potentially be Celsius. The downside here is that growth stocks often go through strong phases of overvaluation based on hype, and then you see that the struggles hit hard, leading to short-term setbacks and a subsequent decline in the market. Celsius has just dropped about 72% in just 1 year. I have Celsius on my watch list. I find it an interesting company, interesting with good potential, but it still holds me back from buying, and I think that's a bad choice. In any case, based on technical analysis, we see that the price is stabilizing, while the MACD is starting to increase slowly and the stochastics are also beginning to turn positive. That's often a positive signal from technical analysis in the short term. There are also fundamental developments. Celsius has already announced that this year will be a transition year, which will be more challenging, but we have closed a big deal with PepsiCo. That's a huge deal, and it certainly opens up opportunities for further growth potential for Celsius. The only question is whether the current valuation is interesting enough to buy, and it could very well be that the price drops a bit further, making the valuation at least more attractive. But yeah, that's the whole story when it comes to investing. Is that the right moment to enter? And I can't determine that at this moment, and that doesn't make it enough. So for me, it's like, if it's not obvious that the valuation is below the intrinsic value and there's not enough margin of safety, then I'm not going to jump in because I've already got too much in my portfolio. And why would I take the risk? Because I already have too much in my portfolio. And why would I take the risk? Looking at Celsius purely based on some facts, in any case, in the short term, you see that even after a significant price drop, by the way, where the price to earnings ratio was just 120, so really another example of Mr. Market driven by emotions and hype, and beginner investors often jump in somewhere around the peak. The market is driven by emotions and hype, and beginner investors often jump in somewhere around the peak. It's a shame, but the experienced investors know better. Still, we see that the price is still objectively above the fair value, at least until end of 2027. This is at least the forecast from analysts, and of course, it's also partly based on the forecast from management, but not entirely, of course. So this could also turn out to be quite disappointing, but despite a decline, the price to earnings ratio is still around 30 to 40, so that's still on the higher side, even though it's a good company. Yeah, and what kind of multiple are you going to use over the next 3 years? Now, let's say you take a higher multiple, like 40. Okay, then there's indeed a potential return of 20%. But you can easily imagine that if you take a higher price for the future, then there's a lot more uncertainty. First of all, the profit growth needs to be realized. Secondly, there could also be a market setback or just a change in perception regarding Celsius, that it no longer has the growth potential. And then you're talking about 3 years and you never know what will happen in 3 years. So why would you take the risk if you're not sure? If you look at a multiple of, for example, 20, which is already a relatively high valuation, then you have a potential loss if you buy at this price level. So that's just a very quick summary of my thought process about Celsius over the past few years that I've been following it. I've been watching this price drop for a long time and it's starting to stabilize. So yeah, you might think, okay, I'll buy the dip. But to be honest, I'm not sure. And that's my honest answer. And if I'm not sure, then I just do nothing at all. Another stock you might have never heard of, and purely for inspiration because it fits within the context of this video, is Bellring Brands. Now, I follow thousands of stocks in our watch lists, all kinds of stocks that I keep an eye on, and a lot of screeners that we study daily. From all these top stocks, we analyze a potentially great growth stock, a value stock, and a dividend stock every month, and we publish that on our website, for which you can also gain access for just 99 euros per year. So we actually filter through a lot of countless stocks, 10,000 stocks, including ETFs, filtering the potentially best opportunities. Well, one of the companies I've been following for a while is Bellring Brands, and it's actually the same situation as with Celsius. I find it a very interesting company, but I'm not buying yet because of the valuation. Bellring Brands comes up because, just like Celsius, they actually have only one. Yeah. Celsius has multiple types of products, and so does Bellring Brands, but the majority of the revenue comes from one product, and Celsius has a lot of caffeine in their products, so that's still a bit uncertain with the regulations. But Bellring Brands makes a product for premium protein and a kind of protein shakes that are relatively cheap, high quality, and good for protein. So that's much more, yeah, focused on health for the future as well. I think it's a bit more viable. What I also really like is that the management is led by a female CEO, and I think it's always good to have women in higher positions. Now, the stock hasn't dropped, so this isn't a buy the dip opportunity. This is actually a chance to buy into strong upward potential. Momentum, I haven't bought shares yet because the valuation is high. Historically, its price to earnings ratio is high. And I also remain patiently waiting until everything turns against it and the valuation is relatively lower. Now, if you look at the historical valuation, the price to earnings ratio has always been relatively high for this company. And 2022, it was a bit lower with a price to earnings ratio of 21. And actually, here, 2022, the price to earnings ratio was around 18. What could have been a better entry point? I actually hadn't followed Bellring yet at that time. I've only been following since 2023. If you had bought at a lower valuation, yeah, wow, a return of 250%, that's obviously a lot, but that's looking back in hindsight. However, the basis of valuation is always never forget the price and the valuation, because the upward potential is nowhere near as great as when you buy at a lower price, and, much more importantly, the downside risk is lower when you buy at a lower price. But the crucial condition is future profit growth. So you can buy a company with a price to earnings ratio of 3, but if a company goes bankrupt in 2 years, you'll still lose all your money. Belgian Brands, super interesting. Definitely give it a follow. Maybe you have more insight into the company. Let me know. My current price to earnings ratio is still always above 30. I still find that a bit on the high side, and knowing that the entire stock market, especially American stocks, is high, everything is just uncertain. So I keep patiently waiting. Potential forecasting is actually the same story as Celsius, higher price. So you also need to have a higher price to earnings ratio in the future. Suppose it stays this high, above 30, 36. Then you could achieve a return of 10% or 15% on average. It could even be more. However, yes, a correction within the next 3 years could also happen, and then you never know for sure. If the earnings estimates are lower than expected, there will also be a drop in the stock price, so a potential loss is also possible. That's, of course, the downside of good stocks, less certainty, because more depends on the future. And we've discussed a number of value stocks, more established companies that might be undervalued despite their recent price drops. Yes, it's up to you where you want to invest. I'm not saying you should invest in any of these stocks. It's all purely for inspiration. I don't have a position in any of these stocks myself. If I were more interested in any of these stocks, it would either be Bellring Brands, possibly Celsius or PepsiCo,